Good morning, grade 10s. Today we're going to look at the first adjustment, namely depreciation, specifically how to calculate it. So what is depreciation? Depreciation is a result of wear and tear, specifically on assets such as vehicles and equipment. And those wear and tear is called depreciation. So depreciation is the cost of using the asset and is calculated annually at the end of the financial year. Depreciation is then written off against the asset and is in expense. The amount is obviously not physically paid. We don't pay it. It is therefore called a imputed expense. Depreciation is an imputed expense because the asset is linked to a specific accounting period. Now, there are two ways in calculating these depreciation. The first one is the fixed asset method or the cost price. In maths, you also call it the straight line method. And the other method is the diminishing or book value method. You can also look in your textbook on page 313, there's an example on the cost price one. And in page 313, there's one on the diminishing value. We today going to do the one that's in your notes in order to understand that. Now, with the first example, they say that vehicles with a cost price of 60,000, we need to write off depreciation of 20% on cost price. So the calculation is just going to be simple, 60,000 times 20%, and that gives you 12,000 Rand. Now the accumulated depreciation, that is the depreciation from the beginning of the period that we have the vehicle up until now, it's also 12,000 because we didn't have any depreciation before that. The next financial year, depreciation is then exactly the same because it's 60,000 times 20%, which gives me 12,000 again. But now the accumulated depreciation is 12,000 plus 12,000, which gives me 24,000. If we have this vehicle a third year, depreciation again is going to be 12,000. But accumulated depreciation will now be 36,000. If we look now at the diminishing balance method or book value method, we will start off with, maybe I can just clear this for the moment. We will start off with the 40,000 times 50% because they say it's equipment at 40,000. And we write off at 15% on diminishing balance. So we start off in the first year, it's 6,000. So accumulated depreciation is 6,000. The next year, the balance of the equipment is then actually less because we're going to say 40,000 minus 6,000 because it is the diminishing balance method. And the calculation will then look like that. So you can see now that the depreciation is less than the previous year. So my accumulated depreciation is now 6,000 plus 5,100. That gives me 11,100. The third year, we're then going to have 40,000 minus 11,100. That gives me a 4,335. You can now also see it's still becoming less. So my accumulated depreciation is then 11,100 plus 4,335, which gives me 15,435. So we're now going to do a few activities on this.